we'll go through what a contribution margin income statement looks like. So most of the time you'll find this type of statement in managerial accounting because we'll be using sales, and instead of subtracting gross profit like we do in financial accounting, we're going to subtract variable costs. And then we'll end up with this subtotal called contribution margin. And in financial accounting, we usually call it gross profit. So I'm just going to use an example. And let's just pretend we're selling yoga pants. Okay, and let's pretend that we sell them for $2 each. So these are really cheap yoga pants. And then we're going to subtract our variable costs. So these are the costs that are incurred in order to make the pants. So the materials for the yoga pants, or the labor put into sew the yoga pants together. And let's just pretend that it only costs us 80 cents. So then when you take 2 minus 80 cents, you end up with contribution margin. And that's $1.20. Now, if I also want to look at this in terms of percentages, and everything is a percentage of sales, then if I take 80 and divide that by $2, so 0.8 divided by 2, that would be 40% of your sales. And if you take your contribution margin, so 1.2 and divide that by 2, that ends up being 60% of your sales. So in this question, let's just assume that we're selling 80,000 pairs of yoga pants. So if I take 80,000 and I times it by $2, that means in total, I would have sold $160,000 worth in yoga pants. And if you take 80,000 times by the 0.8, that gives you 64,000. So that's how much it cost you to make the yoga pants. So then the leftover amount is 96. So you would just take 160 minus 64 to give you the 96,000. And from here, what we'll do is we'll subtract our fixed costs. So what these costs are costs that never change. So that means that if I sell one pair of yoga pants, I'll still have to pay these fixed costs. If I sell 300 pairs of yoga pants, I'll still have to pay the same amount in fixed costs. And I guess the easiest one to think about is your rent. Your rent stays the same every month, regardless of how many yoga pants you end up selling. So in this situation, let's just pretend our fixed costs are 60,000. So now if we take 96 from 60,000, that gives us our earnings before interest and taxes. And then we can subtract our interest. And let's just say our interest is 12,000. And so then you'd subtract the 36 from the 12, and then that gives us earnings before taxes. And then let's just assume that our taxes are 50% of our earnings before taxes. So then we'll subtract 12,000 from that. And then our earnings after tax will be 12,000. So that's just completing the statement.